That is a bold claim. For millions of investors, SCHD, the Schwab U.S. Dividend Equity ETF, isn't just an option. It is the option, the king. It's the benchmark, the default, the undisputed champion that has masterfully balanced quality, yield, and fantastic growth. The common belief is that you can just buy SCHD, set it on dividend reinvestment, and forget about it for 30 years. It's seen as the perfect one-stop solution. It seems unbeatable. But what if that's wrong? What if the very strategy that made SCHD so dominant in the last decade is the exact thing that will cause it to underperform in the next? We are at an economic crossroads. The 2010s, defined by low rates and steady growth, are over. The 2020s and 2030s are a new era of inflation, volatility, and a new AI-driven technological regime. The question is no longer how good was SCHD? The question is SCHD's rulebook a rulebook written for the last war, ready for the next one? Today, we're going to find out. We will put the king to the test. First, we will deconstruct SCHD's core DNA to understand exactly what it's built for. Then we will put it in the ring against 4 unique challengers, specialists built with entirely different philosophies. By the end of this video, you will know exactly how SCHD's strategy could fail, and which of these 4 challengers, if any, has the right strategy to dethrone the king by 2030. Before we can talk about what might beat SCHD, we have to be clear about what it is. Why is it so beloved? Because SCHD's methodology is a masterclass in checking all the right boxes. It doesn't just chase high yield, which is often a trap. It brilliantly combines 4 powerful metrics into one rules-based system. SCHD tracks the Dow Jones U.S. Dividend 100 Index. Here's how it's built. First, they start with a massive universe, the Dow Jones U.S. Broad Market Index. From there, they apply the first and most important filter, the 10-year rule. A company must have paid a dividend for at least 10 consecutive years. This is the non-negotiable quality screen. It immediately filters out speculative, fly-by-night companies, leaving you with your Coca-Colas, Home Depots, and Texas Instruments. After filtering for basic size, they get to the secret sauce. They rank all remaining stocks on 4 fundamental metrics: free cash flow to total debt, a stress test for cash generation versus debt; return on equity, ROE, a profitability test of management's effectiveness; dividend yield, the income test; 5-year dividend growth rate, the growth test, ensuring the dividend is rising. The index ranks every stock on a composite score of these 4 factors and selects the top 100. The result is a portfolio of roughly 100 blue chip stocks that are profitable, have strong balance sheets, pay a good yield, and are growing that yield. But here is the most important takeaway. If you look at these screens, you realize SCHD is a passive, rules-based large-cap value fund. Its 10-year history screen is backward-looking. Its financial ratios, ROE, cash flow to debt, and yield, are classic value investing metrics. This strategy was unbeatable in a low-rate environment. But this strategy also has a big blind spot. Its obsession with a 10-year history and high yield often filters out some of the best-performing, highest-growth companies on the planet. Think about Microsoft. It's one of the greatest dividend growth stocks ever, but its yield is often too low to make SCHD's high-yield cut. SCHD's strategy is to buy quality on sale. The risk is that in the new economy, the real winners are the quality at a premium stocks, and SCHD's own rulebook forbids it from buying them. This is the crack in the king's armor. And it's the exact opening our first 2 challengers are built to exploit. Meet the orthodox challengers, Vanguard's VIG and BlackRock's DGRO. Like SCHD, these are massive, cheap, and designed to be the core of your portfolio, but they each have one critical difference in their philosophy. First up is VIG, the Vanguard Dividend Appreciation ETF. VIG's strategy is beautifully simple. It tracks the S&P U.S. Dividend Growers Index. Its primary rule is almost identical to SCHD's, a 10-plus-year history of dividend growth. But here is the game-changing difference. That's it. That's the only screen. VIG does not screen for high yield. It does not screen for value metrics. It only asks one question: have you reliably grown your dividend for over a decade? This simple one-rule difference completely changes the DNA of the fund. While SCHD is overweight on value sectors like financials and industrials, VIG is a closet tech growth fund. As of this analysis, VIG's single largest sector is information technology at a whopping 27%. Its top holdings include Microsoft, Apple, Broadcom, and Eli Lilly, the very quality growth megacaps SCHD's value and yield screen often filters out. So here is the 2030 argument for VIG. If you believe the next decade will be just like the last, dominated by high-growth tech and healthcare giants, then VIG is the pure play bet on that future. SCHD's value-based rules will force it to sit on the sidelines, while VIG's simple quality growth screen allows it to ride the real winners to the top. But what if you don't want to make such a massive bet on tech? What if you fear getting trapped in a dividend dinosaur? This brings us to challenger number 2, DGRO, the iShares Core Dividend Growth ETF. If VIG is the past performance fund, 10-year history, and SCHD is the present value fund, current yield, then DGRO is the future-proof fund. DGRO tracks the Morningstar U.S. Dividend Growth Index, and its strategy is brilliantly forward-looking. First, its history screen is shorter, only 5 consecutive years of dividend growth, getting newer companies in faster. But here is its secret sauce, a sustainability screen. DGRO only includes companies whose dividend payout ratio is below 75%. This screen is not backward-looking, it's forward-looking, asking, can this company afford to keep growing its dividend? It's a dividend safety filter. This one rule change has 2 massive consequences. First, a more balanced portfolio. DGRO holds over 400 stocks compared to SCHD's concentrated 100. This diversification protects you from sector-specific meltdowns. Second, it actively screens out dividend dinosaurs, those high-yielding companies with great 10-year track records, but whose profits are shrinking and payout ratios are soaring. These are the yield traps SCHD's backward-looking screen can miss. So here is the 2030 argument for DGRO. If you believe the 2030s will be an unpredictable and bumpy ride, DGRO is the all-weather, sleep-at-night choice. Its broader diversification and forward-looking safety screen provide a smoother compounding path, avoiding the concentration risk of SCHD and the tech-heavy bet of VIG. We've seen the core challengers. Now we move on to the specialists. These 2 funds aren't just trying to beat SCHD at its own game. They are playing a completely different sport. First up is FDVV, the Fidelity High Dividend ETF. This fund's name is dangerously misleading. You hear Fidelity High Dividend and you picture a sleepy portfolio of utility companies. You could not be more wrong. FDVV is a strategic beta fund with aggressive rules. It finds high dividend stocks with strong value and quality scores, and then it momentum scores them. The result is not a value fund. It is a high-octane, hyper-concentrated growth and momentum fund that just happens to pay a dividend. How do we know? Look under the hood. This high dividend fund's largest sector is technology, at over 26%. As of this analysis, it has a staggering 6.68% single stock position in NVIDIA. This is not a dividend fund. This is a factor bet. This strategy led to explosive performance, a 19.67% compound annual growth rate over 5 years, crushing the others. But it's a brutal ride. In the 2020 crash, it had the worst drawdown of the group, falling a painful minus 28.35%. So here's the 2030 argument for FDVV. If you are a high-risk, high-reward investor, and you believe the AI-driven, high-momentum tech boom is the defining economic engine of the next decade, then FDVV is your leveraged bet on that future. It is the high-risk, high-reward path to destroying SCHD's total return. That brings us to our 4th and final challenger, DIVO, the Amplify Enhanced Dividend Income ETF. VIG, DGRO, and FDVV are all passive. DIVO is actively managed. You are paying its 0.56% expense ratio for a team to make smart decisions. They execute a brilliant 2-part strategy. Part 1, stock selection. DIVO's managers buy a highly concentrated portfolio of just 20 to 25 blue-chip dividend-growing stocks. Think Microsoft, Procter & Gamble, American Express. Part 2, the income machine. This is the secret. The managers then actively write covered calls on their stocks to generate high, consistent monthly income. A covered call is when you sell someone the right to buy your stock at a higher price, and in return, you get paid a premium right now. This premium is pure cash income. Why is this so powerful? Let's look at the magic trade-off. Over a 5-year period, DIVO delivered fantastic equity-like returns, a 14.39% compound annual growth rate, right there with the big dogs. But its risk was non-existent. In its entire history, DIVO's all-time max drawdown was a tiny minus 13.29%. While other funds were crashing minus 22% or minus 28%, DIVO barely flinched. It provides the smoother ride. And this brings us to the most important 2030 argument of all. What if the next decade is not a raging bull market? What if the future is volatile, choppy, and trades sideways for 5 years straight? In that world, SCHD's buy and hold value-based strategy will go nowhere. VIG and FDVV will be getting crushed. But DIVO is built for this. In a flat or volatile market, its blue-chip stocks hold their ground, and the covered call strategy continues to generate high-income premiums month after month. DIVO manufactures its own returns when the market provides none. If you believe the 2030s will be a volatile mess, DIVO is the only fund of the group specifically designed to win in that exact environment. So which of these 4 ETFs could destroy SCHD by 2030? We've learned that destroying SCHD isn't a simple question. It's about strategy. SCHD is the king of a very specific style, passive, rules-based, large-cap value. Its dominance in the 2010s was the result of that strategy working perfectly in a low-rate world. Its performance in the 2030s will depend on whether that same strategy is the right one for a new economic era. The winner of the next decade will be the investor who correctly matches their tool to their prediction of the future. Here is the final verdict. If you believe the world returns to a normal, stable, value-driven market, stick with the king, SCHD. It's the king for a reason. If you believe the next 10 years will be a repeat of the last, where high-growth, quality tech companies are the only real winners, then VIG is your pure play. If you believe the next 10 years will be a minefield of dividend traps and unpredictable sector rotations, then DGRO is your all-weather, sustainable choice. If you're a high-risk investor and believe the AI-fueled momentum boom is just getting started, then FDVV is your leveraged, high-octane bet. And finally, if you believe the next 10 years will be volatile, choppy, and range-bound, a market that grinds nowhere, then DIVO is the clear strategic choice, designed to manufacture income when SCHD would be dead in the water. The biggest risk for an investor isn't that SCHD is a bad fund. It's not. It's a great fund. The biggest risk is blindly holding SCHD, a passive value fund, and expecting it to win in a volatile, high-growth, or choppy market that it was never, ever designed for. The king is only king of his own castle. The question you have to answer is whether the entire battlefield is about to change.